Well, good afternoon, thank you. So we are the only thing standing between you and cocktails, so give us a little bit of a break. But we are here today and super excited to be here this afternoon. I'm Adrienne Andrews. I'm Managing Director at JLL Capital Markets and Hotels and Hospitality Group. We are a global commercial real estate services firm and the largest debt advisory in the country. In 2024, we did $66 billion, $7 billion of those in hospitality. I'm super excited to be joined here by a number of very productive hospitality-focused lenders. I'll go ahead and let them introduce themselves, starting with Jared.
Hey everyone, Jared Schlosser. I work for Peachtree Group. I run hotel originations and CPACE, and based here in Atlanta. Excited to see everybody.
James Ravitas. I run production development for Access Point, a bridge lender and capital provider to the hotel space. We're headquartered in Atlanta, do nationwide hotels.
Hey, good afternoon, everyone. Anand Jobanputra. I co-head our hospitality finance group, responsible for the balance sheet within Wells Fargo, exclusively for hospitality. We finance hotels all across the country, Canada, the UK, and it's about a $10 billion book on our balance sheet.
James Petty, Western Alliance, part of the HFF team. We do mostly hotels, or in our group we do all hotels. The bank's an $80 billion bank, has many other commercial real estate groups that we work with. And we've been leaning into construction and note-on-note for hospitality in the last 18 months as well.
Awesome. Well, thank you all for being here. So we have spent, I think, the last handful of months hearing that there is a tremendous amount of capital on the sidelines. We are seeing that throughout the market. Every lender that we talk to that put out $1 last year wants to put out $1.50, $2 this year. We're seeing it across the spectrum in terms of the life companies, CMBS, banks, credit unions, and the debt funds. With that being said, transaction volume has been a little bit lighter, so I'm curious to see and hear from this group of panelists what you're working on today and how you're looking at deals in the current environment. Jared, would you like to start?
Sure. We've been really active. We probably did about 800 plus million of hotel loans last year, 900 plus if you include CPACE. This year to date, we're close to 500 million between CPACE and hotels. We feel like there's a great opportunity to go out and make loans right now, and it's a strange environment where a lot of the equity groups that were unable to put out equity have ventured into lending, but they don't exactly know what they're doing yet, or may not know what they're doing. So it's created an environment for us where there's certainly new competition, but there's also a lot more of those phone calls. Hey Jared, we were down the line with somebody and they didn't get there. Can you help us out? So it's been a good time to make hotel loans. It's certainly, with everything going on in the economy, is not an easy time to underwrite a sub 12 debt yield deal. But when you have a focus in hospitality, you're able to, lean into deals that work and stay away from those that don't.
James, you and Jared play in some of the same space in terms of, unstabilized assets in a lot of respects on the path forward to stabilization. How do you guys look at the market today relative to that?
Sure. Yeah, so we've been pretty active, right? I mean, I think we published it last 60 days, we've probably done 366 million closed. Last year, about $500 million a bridge, and just some other price. So similar numbers, we don't do CPACE. So a lot of opportunities, but it's a lot. We chop a lot of wood to get there. We looked at 800 plus deals last year, like for real 800 deals, not like 800 phone calls to get to 30 or 40 transactions or assets, split between portfolios. So I think we look at it as there's definitely deals out there. Just like buyer and seller capitulation, right? Bid-ask spread, there's realistic conversations you have to have with your lender about like cash in, cash neutral expectations around like what's actually gonna happen with the asset. And I think that kind of is starting to tighten over the last year, where it's like you can have more realistic conversations. But I do think there's, we are seeing external like pressures, but I think, when you talk to groups like ours, what we've really started to focus on is like what actually works and if there's realistic expectations and like certainty of closing and getting a transaction done versus trying to go with somebody else who's newer to the bridge lending space or capital providing space that's going to be less reliable for your transactions. That's been, when I think about that, it's about having candid conversations with our sponsors about like what the reality of the market is today.
Got it. So Anand and Jim, you guys are both utilizing your balance sheets and also tend to be fairly focused on sponsorship, as everyone is in any environment, but certainly perhaps more in the heightened market where there is volatility. Talk to us a bit about what you guys are focused on today.
Yeah, I can start, Jim. I think last year was a record year for the CMBS space, and so you had a lot of banks who had balance sheet debt have loan runoff, either into the CMBS space or whether through sales to another bank, et cetera. And so if you look at the earnings reports of a lot of larger banks, you'll see that they were missing on interest income, right? And so now their philosophy has changed, and they want to put loans out the door, interest income. They want interest income. So now you've seen a lot of the regional banks, a lot of the larger banks, like the JPs and the B of A's and the Wells, come back into the space and look for interest income and look to put money out the door. So I would tell you now we're probably the active most. Probably have $1 billion in the pipeline today for just hotels. Probably the most active we've been in a long time for the space. Again, very borrower specific, that kind of 12 debt yield, standing loans. We don't do a lot of construction. We are seeing a lot more competition come into the space. Spreads have come down, LTVs have gone up, and banks want to put money out the door.
So I think that we lean into relationship more today than we did in years past. Our balance sheet is for hotels is very, very clean. We were able to affect some things last year and get some resolutions because of our relationship, so that's worked very well. We actually are closing a construction loan for one of our largest relationships tomorrow. In something that was actually delayed 11 months. And we stuck with them and we're closing, and we'll start the distributions here as they get through their equity. So we're very much relationship oriented. We do want to put money out as much as everybody else. We are going to start coveting new relationships with the select few people that we really have been focused on for the last couple of years. I think that as everybody's looked at it in the past, there's always a flight to quality. I think that's more so in today's schizophrenic environment. I think if you look 60 days ago, everybody was popping the champagne. Trump's in office. We're going to pop this thing. Stock market's going to 12,000, whatever or 120,000. Everybody was all excited, and then that word tariff popped up. So now everybody's like, "What the heck's going on?" So. I think there's a lot of people look at this as opportunity. We're going to partner with those people. And the people that look at this as a batten down the hatches moment, I think the people we partner with are going to eat their lunch and make a lot of damn money.
So that's great. So I think what's interesting is you all hit on being incredibly active in the space, really wanting to understand the business plan, understand the sponsorship. But we're continuing to see spreads tighten. And so one of the things that often happens in an environment where spreads are tightening is you just start to see credit quality deteriorate. And I didn't hear from any of you that that's on the shelf at this point. Nad, you talked about the $1 billion. When you think about the last couple of years and the volume that you've put out, has your credit quality or the metrics that you're looking at changed?
No, I think you got to find that right balance, right? Like, what does that sponsor want? Do they want spread? We're actually, frankly, would give up a little bit of spread for some more structure, right? Because we're keeping that asset on the balance sheet for a long period of time, and so call it 3+1+1 type financing. And so for us, it's like finding that right balance, kind of what's important for that sponsor. And some sponsors just want the lowest rate you can find, right? And they're willing to give up structure, whether it's recourse or amortization or what have you. And so I think that makes a difference. And so very sponsor specific when it comes to each deal we look at.
I think also to that point, I think we think but a little different, like same but different, is on for stuff that we think is less risky, right, that's where we'd be more willing to do spread compression, but we're not moving if we think that it's where we should have been, right? So maybe on the better end of things, that's where we have our internal like tightening, and then we're also getting, our back leverage, sources. We have them. I don't think they're getting more aggressive, so that actually helps us kind of be where we need to be if they're trying to put more money out. So there's a little bit of that, but I still think it's not that hard deals are getting spread compression. I think it's the best deals are getting spread compression. The hard deals are maybe actually spreads could be widening because I think there's a flight to quality where they go, actually I think that's a better trade. So there's kind of a little bit. I don't think it's kind of across the board. It's a little.
I think you're right. It's not across the board. I do think there's a flight to quality. So on your better deals with your better locations with your better flags, you're going to get a little bit of compression or relief. We've just enjoyed partnering with the right people. If you look at our group, which we have a lot of alumni that are different groups now, we were kind of a core that exploded and did a few other things and helped seed some other lending groups. We've been doing it for 16 years the same damn way. You partner with the right people and you do deals and you take care of each other. So I think that got us through two big market adjustments, and if there's a third, it will get us through that. So I think if you just stick to your principles and have a little faith in your people, this too shall pass.
Yeah, I mean, it's really interesting, right? You're in a window, but how big is that window and when does it shut? Because, right, we're all on the stage. There's other lenders out here running around the conference, and yes, I think there's a lot of capital to be put out, and so there's competition, and competition drives down spreads. But when you start looking at the data, you're inevitably taking on more risk making a hotel loan today than you did 90 days ago.
Yes.
So at what point do people wake up and say, I don't know, this deal looked really good before, but now I'm looking at 90 days of data and suddenly the market's backtracking, and can I really underwrite this pop, and am I lending at the top of the market here? It's a period of time where if I was sitting out in the audience and I had a deal in front of somebody, I'd be calling them every day to get it signed up and get it closed, because come this summer, if data continues to head in a negative direction, I think that spread compression is going to go out the window, or at least the liquidity behind it is going to be few and far between.
Well,
And that's happened to us in the past in different cycles.
Yeah, before we were talking about correction, right? Now we're talking about recession. So again, I agree with what Jared said. The music will stop. We don't know, does it stop next week, or does it stop 6 months down the road, or do we just continue to play it, but just play it softly? No one really knows, but there's so much uncertainty and things are changing every day.
But it's interesting, right? Because hospitality has become a more institutional asset class. We're seeing, frankly, with office getting on the sidelines and really Class A office being at very limited levels of liquidity with low leverage, hospitality is filling a gap for a number of lender segments. 10 days ago, actually 11 days ago now, I had a life company call me and say, hey, I'd like to deploy 250 to 300 million in select service quality product. We've never had life companies call and say, I'd like hotels. And so for a period of time, we were the redheaded stepchild, and we're in an environment where, you're right, it is becoming inherently more risky when we think about the top line, whether it's insurance, property taxes, and just the volatility in demand, whether it's driven by government spend or otherwise. So we have to be certainly cognizant of it, but it's a far more institutional, and it's shown that it can be incredibly resilient. And so making your way through that, are you discounting pro formas? Are you looking at it and saying, okay, if my debt yield was 12 today, should it be 12 and a half because of this recent volatility?
I don't think anybody has any idea what's coming down the pipe, and I just know how this dance goes, right? You're gonna have, because I was at a life insurance company back in the day before I was at Peachtree, and you walk in the middle of a recession, you're like, hey, I want to do a sub 10 debt yield deal, and some dude yells you to get the F out of his office. And so on the institutional side, I totally agree with you. You can't really do office, although there's some liquidity coming back to office. It's tough to do even some multifamily today. Student housing in certain markets is having struggles. So there isn't that. I think hotels is an asset class that has a little bit more firepower than it did in previous cycles, but if recessions come, people will exit that market, and I think you want to get ahead of it, before data gets worse, if it gets worse.
So with all that, this panel is about 21 to 50 million, a space that has been one of the most liquid over the last 18 months in terms of actual transaction as well as financing. As you think about the volatility, particularly in this space, do you see where you're playing in terms of the asset type, right? So full service used to be 50% of the volume. Today we have select service and luxury. Obviously, as we start to see recessionary pressure, we'll see pressure on the luxury side, and select service will remain in favor to the extent that corporate and group demand holds up. Do you see where you play moving in light of the fact that, there's a number of things going on?
Yeah, I mean, I think from the Peachtree side, we're looking at, like Jim said, good sponsors with good business plans. We tend to focus on newer assets because new wins in this market, even in recessionary times. And is it a basis that makes sense, or are you building for a number that we can pencil? Are you buying for a number that we can pencil? If it's a refi, how did the last few years go? And we're doing deals that are, 2 and 3 debt yields, but it's got a business plan, a story, and it's a strong sponsor that's willing to put some cash in and, stick with the asset and show that they're tried and true. So I think there's certainly a lender for every type of deal, but where we've really done a lot of volume in that particular space is kind of newer assets, limited select service, premium branded hotels that have strong sponsorship, or at least have a market or business plan that we can underwrite.
I'd double down on sponsor, where it just, we like, multi-unit owners experience, preferably with like an operating arm attached. So from that, there's a lot of, you got to roll up your sleeves to get those margins up, because we're kind of not thinking it's top line driven. And so good stories, good packages, not just hey, this is what I need and the underwriting doesn't work. Like, we're getting pretty good at being like, hey, like, I don't think these guys have got the grit to kind of get this done. And like, that's a weird thing to say, like grit, but it's very much something we talk about. Like, it's not just like the asset, right? It's like the people behind it, because like, once again, like, despite, what you may have heard, like, we don't want to take these back, right? I want this to work out for you. I want it to work out for us. I would like it to be refied over to these guys later on. We're a stop on the way if it's a transitional kind of asset. And so I think, a lot of those things, like, but deals are getting done, right? Like, I mean, look, the closed deals show you guys it's getting done. It's just like, I would say to probably a person, right? It's people who came in with a tight story that made sense, or the asset like was very understandable. It was not a, for like, half-ass kind of thing put together.
So Jim, you talked about new customers, right? So we're talking, everyone here has talked about sponsorship, but you're open to and considering new customers, right? What does it take for it to be interesting to you guys?
Well, this might be one of the smallest tight-knit industries around, right? Through STAR, we share information. Everybody knows everybody. I think half of my friends are related to each other one way or another. I hear a brother, cousin all the time, so I think they're actually all related. I think I'm related to half of my buddies as well. I don't know how, but I've been invited to 2 family reunions, so we all know each other. So reputation matters. Your actions in the last 10 years matter. People know. This is such a, somebody was, Aaron that works with our team, was telling me that, on the LexisNexis stuff, the information we used to have to dig for and pay a fee to get, we don't have anymore. All you got to do is Google it. So we know everything that's been done. We know the players in the market. And there's coveted relationships that we do not enjoy a relationship or have balance out with today that, we're going to make it a personal mission in the next 6 to 9 months that we're going to have a relationship and we're going to get that done. So, again, actions matter, and what you did in the last 8 to 10 years, if you did the right things, we're going to come and try to reward our mutual benefit relationship and get that going.
So to be clear, there are deals that are getting done with groups outside of these guys that somebody doesn't have 50 hotels, right? Where if you don't have maybe the history that Jim speaks of, partnering with a management company. We've got a deal right now, we're doing an independent resort. That's got a very strong management company. They're providing the support and the operating side to really get to where James or Jared might be comfortable, right? They're coming in early and helping provide that institutional knowledge which is necessary. From that standpoint, Nod, how do you look at the ownership versus the management company when you're underwriting any potential upside?
Yeah, I mean, look, ownership matters, and to us, even the manager matters. I mean, we financed the hotel for one owner and a different manager, and then refinance it for a different owner and different manager, and it's performed 50% better, right? So to us, we spend a lot of time on the underwriting, spend a lot of time, because a lot of people asset manage the hotel a lot better than the next guy, right? So we've seen actually hotels also go the other way, where one of our clients will sell it to another sponsor of ours, and we'll keep the loan on our books, and it just hasn't done as well because that sponsor was from this city, managed it for a while, actually developed the hotel, knew it really well, and then when they sold it, these guys tried to turn it around, pick a different manager, and it just didn't do as well. So I think you got to pay attention to the details, and each property is different, both managed and ownership-wise. Yeah.
So thinking about each property being different, we're in an environment where policy matters, labor matters. Do you guys look at the labor, which is such a substantial piece of the P&L, about where you're financing more critically than any other component of the P&L, or how are you dealing with the fact that there's tremendous noise in the labor, which is one of the most expensive pieces of the P&L right now?
Yeah, I mean, I know we certainly underwrite it. We underwrite like owners. James's point, we've made 500 plus loans since I've been there, and we've taken back less than a handful of them. So we're not in the loan to own space, but we're going to certainly underwrite the same way that the borrower's underwriting. So it matters. The P&L matters. There's nothing from a lender perspective that turns you off to a deal than somebody who sends you a package with the wrong taxes and insurance on it. Or something that doesn't make any sense from a labor perspective, because you can look at it and you're like, what the hell is this? And if you're getting 10 of those deals a day, you're flipping that one to the side. So it matters, and it should be important to everybody who's lending on a hotel, because if your borrower doesn't get it done, you're the one that's going to be paying those expenses.
Yeah, it's not just labor. I mean, he's right. Like insurance costs, like in Florida, have gone up, 2 or 3 times, right? And so it's not always labor. Like California, of course, labor is probably the most, but I think it's all across the P&L. That middle of the page, we're seeing increases in every line item, right? And so we pay close attention to that. We have a full underwriting team. Actually, we have 20 people on our underwriting team that underwrites hotels, and that's all they do, right? And they spend time asset by assets, city by city, focusing on what does the underwriting of that hotel look like.
Yeah, we do a little bit on the inverse. We focus on the NOI margin drop, and if it's not in the sweet spot that we're looking for, and then we'll start really diving into what is out of balance, and then why is that out of balance? Is that correctable or is it not correctable? And then you can size off of that. So, yeah, expenses have gone up. They seem to be stabilizing, but again, it's a schizophrenic market right now. So, yeah, I think it kind of depends on regions.
And I think to your point, we also as lenders, right, have portfolios that we can look to see what's happening, right? So like our capital touches 220 hotels, 22,000 keys, right? It's not like we're naive about what's happening with margins. So to that extent, doubling down on yes, we understand that there are certain things, certain collective bargaining or things like that we avoid in certain markets just because it's just not what our capital base wants. But when it comes to, underwriting assets, kind of going full circle on, do we think about the labor? Yes. And then also on top of that, it goes back to, have you thought through your deal enough when you're putting a package in front of your lender, when you're competing for their attention and things like that, where we talk about like we did. I think it was 33 transactions between portfolio deals and direct investment last year. We logged 850 bona fide inquiries, like real inquiries, like we're about like real hotels that would be in our purview hypothetically. We're not on stuff that we don't even bother some of that log, and maybe I don't know, maybe Mike's in to that, but like. So you think about that conversion rate, like looking at 850 opportunities down to 33 assets, like these teams are not huge. I mean, even 20 underwriting inbound on. So I guess the point is there's a little bit of like, do you think about it? Yes. It's like, do you also think about how well you've thought it through and you're presenting your information? Because like, you might and it sounds absurd, you might get 15 minutes of a business development director's like time, and then you might get 3 minutes of my time to like get this to committee. And if it's like, well, their stuff was a little wonky and they didn't think it, whatever, you go like, is this going to extrapolate through our whole process? And then it goes back to, did they really think it through? Are their margins right? Like, are they respecting that process and like how like having reverence for what the market is doing right now? I don't know, it might sound a little where like we want to do the business, but it's like it's very quickly like if you want us to learn and spend time with it, you need to like show us that you've thought it through too.
Right. So you talked about your book and utilizing it as a way to, frankly, underwrite and review new deals. One of the pieces of information that was talked about yesterday was about the fact that lenders will have to start pushing out deals, right? And so you guys are sitting as lenders going into the future, active lenders today on new deals, but you also have a book of business. How are those deals faring? Are you any of the lenders that are having to manage your book and manage people out? And if so, where are they going? What's your recommendation to people in this audience that frankly have maturing loans or are potentially being pushed out by the lender to find another solution?
I mean, another man's trash is Jared's treasure.
There it is.
We've done over $1 billion of refis in the last 18 months because somebody got pushed out of a bank and their debt yield wasn't stabilized, so they couldn't go CMBS or permanent, and they came to us. And if the deal makes sense, we're happy to take on the new relationship. And it's been one of the real joys of lending right now is being able to grow that book and grow that relationship. But I do think if for whatever reason the bank is to Jim's earlier point about relationships, if you haven't managed that relationship and you got to go elsewhere, you're probably going to go to somebody like us.
Yeah, I mean, as a bank, I would say start that conversation early. Like, don't wait 2-3 months before your maturity to realize, hey, they're going to make you take it off their books. I think overall, banks are looking at overall relationships, so it's not just that loan anymore. It is, hey, do you have treasury with this bank? Have you done a CMBS deal with this bank? Overall, have you done derivatives with this bank? And if there's an overall return for that relationship, banks will try their best to try to keep it on their books and do some type of extension or even refi. But if it's just that one loan and you don't have anything else with that bank is probably going to tell you, all right, there's no overall relationship. We should figure out a way to refi us out or something like that.
Well,
call up Jared. Here's his number.
Or me.
Well, mostly Jared, but anyway, not the Subway Jared, this Jared. That's a different thing. Small joke. No, but to be fair on that, we actually had 2 relationships pay off last year. There was one market that the 3 assets were not performing very well. They were very low NOI. And we ended up working it out with the customer, and we gave them an additional, I think, 4 months and worked through them. And it was not the easiest of conversations because I love these people dearly. But we've already had a conversation here since. Like, hey, we took care of that for you, which they did because actions do matter. And he's like, hey, would you entertain doing another $200 million for me on this? I was like, dude, I love you. You guys were so good to us on the way out. Whatever I can do, I'll be more than happy to help. We had another person that had a 2-asset relationship with us. We just were not comfortable and wanted a little bit of a pay down. He was not comfortable doing the pay down because he thought some local banks could do better for him. He was right, and we were able to give him an additional 90 days. And we peacefully exited each other. And we'll probably be at dinner, hopefully in the next couple of weeks, because I love him and his sister very much. So, it's just in the way you work with your lender. I've been saying it for 4 years. If you don't have a good relationship with a couple lenders, don't come to me after this one, because I'm not looking for new love in the wrong places. Just find a good lender, start a relationship, and work with them, and be very proactive.
So we work with all of these guys and quite literally hundreds of lenders. And what has been fascinating is we are seeing that the relationship matters, right? When someone comes to me for construction, the first question I ask is, have you gone to your local bank, right? Have you gone to a regional bank that knows you, that understands the asset? And if the answer is yes, but, we'll certainly take that on. But there are absolutely times where that can be the most efficient. And, to all of their points, that the existing relationship can help produce, productive spreads and leverage. But you're evaluating the deal as a whole, right? You're evaluating it relative to other opportunities and relative to their book. You're massaging the LTVs, the IO, and trying to figure out the structure that's perfect. And so up here we have, panelists that can frankly do everything. We work with all of these guys. They're very productive. You're in the business of doing business, but it sounds like, there's still some governors, which is good for the industry as a whole. I'm curious, does anybody have questions around their specific deals or anything that we've covered for the panelists here and what they're seeing, or anything specific relative to a structure? This is not, guys, not an exciting panel. It's finance.
Man, we're not
Right
that
before
good.
cocktails.
It's a shy crowd.
No questions? The room's fuller than I thought it would be. But we're apparently that good. Anybody up here want to cover anything additional? We've got a handful of minutes.
No, I think as I was coming in, we were preparing for this on Friday. I think the big thing that we talked about was the tariffs. And I think that turned into, it's not so much about the tariffs. I think if you listened to Teague yesterday, you think, this will pass in the next 3 to 4 months. The Ukraine war will hopefully resolve itself in the next 4 to 6 months. And then you'll know about the economy and stuff. So I think it's more, I think it was Mitch Patel at Vision maybe yesterday was saying, if you have faith in the fundamentals and your people, this could be a time for you to make additional wealth and to gain. There's a lot of people in the past when there is, a disconnect in the market, take advantage of the market. Don't take advantage of people, but take advantage of timing and drive through it. So that would be my recommendation. If you have faith in the fundamentals, you have faith in the market, you have faith in your people, buckle up and let's go.
When you think about it, credit spreads are at historic norm. Frankly, all-in interest rates are at historic norm. This is where hospitality has been for decades, outside of a very short period of time. That was an anomaly. That was a 3 to 4%. So when you think about your underwriting going forward, the levels that we're at today are very productive.
Very doable.
Very doable. And so some of it, to your point, Jim, is a little bit of finding conviction and opportunity in this particular market.
And I think I'll leave you with this. There's a space for all of us, right? There's a deal that fits in Jared's box. There's a deal in James' box or mine and Jim's. Or sometimes you need to hire Adrienne because you don't know the right path to take, right? And she can help you figure it out. And there's not enough cash flow, and you need a short-term bridge loan to help you get through the next 12 months. And then you're going to go to the permanent market, whether it's CMBS or balance sheet with a lender. And we play in different sizes. So just know your audience, know your lenders, know the groups. If you don't, hire a broker. And so you can get the best financing. But each of us play a role in the lending space, and each one of your assets will play a different role in the lending space, and figure out the right box.
I will also say, if a lender's been in the space for 8 to 10 years and can walk through the lobby of a conference like this and not get beat up, I was going to say something else. Not get beat up. He's probably a pretty credible guy, and you should probably,
Or he's very tall.
well, I'd like to say good.
No one wants to get in a fight with you, Jim.
No, I think reputation matters of your lender too. Call around. If you're working with somebody, call around. I mean, everybody knows Anad, everybody knows James, everybody knows Jared, everybody knows Peachtree. We've all been in the industry for a long time. We're not going to hide. We're going to be straight up and deal with people respectfully. So that's all you can ask.
I think agree with all of that, and I think to your point, when it comes to just thinking about the current deal environment, you were touching on, there's no secret behind the discussions. A lot of discussions that we have with our investment committees are the same things that we're pretty open book because it's an easier way to do business, candidly. Where it's like we're not sitting back going like, oh man, I'm really nervous if rates are going to drop or one way or the other. We kind of think of it the same way. It's like this is the deal environment. Like we actually don't think there's going to be material change. Like I'm not too concerned about it one way or the other. Like because every deal is going to need capital, right? And we're pretty flexible up and down this. All of us, or some of us with certain aspects. So the one thing that is if you're sitting there going like, oh, I'm waiting for this thing to materially change, I would tell you that like the four of us collectively aren't expecting some huge shift in this environment this year. Like this is kind of what it's going to be, and so you kind of either have to find a transaction that like works or it doesn't. I don't think there's like you're so good that like 6 months from now you're going to be primed to like make the right call. It's either you got something that kind of works in this environment or not, and until something kind of materially changes. But I don't think anybody up here is forecasting like, you should really be waiting for 6 months to do this thing because that's going to be when it's like the good, spreads.
Fundamentals are today going to be the same ones in 6 months. Maybe slight variance, but we're not going to be. What conference were we at when COVID hit? And we're like, hey, we're not sure, but kind of. That was a bad conference. But I think this one, I just don't see the cliff.
But deals are getting done. Again, we did 55 billion in 2023, 66 billion in 2024 on debt across commercial real estate. It's a lot of dollars. Deals are absolutely getting done.
They're getting done.
We're finding,
Might put in a little more equity, but they're getting done.
And that's part of it too, right? Is like having a little more commitment to your asset is productive for you and it's productive for your lender. And it also may open additional doors. So if your lender is saying, hey, I'd like more equity, it may be that, okay, that's fantastic, and if you love the relationship, it's working and it's perfect and they're competitive, put in the equity and kind of continue the relationship. It also might be that if you're going to put in equity, you might want to look at multiple opportunities to see which one fits based on whatever your investment thesis is going forward, because you probably didn't plan on putting on that equity initially. And so just evaluating your deal and making sure that your capital is aligning with your strategy, I think is another critical piece in this environment.
Yeah, I mean, like you were going down that path, it's 5 years, I think, this week from when COVID hit. I don't remember a normal environment anymore.
Well, you're young, you'll get there.
I'm 40, I might just look young. No, if you kept going in 2020, which some of us did, you can acquire a whole lot of wealth. And I think it's about figuring out a business plan and putting a foot in the ground and say, this is what I'm going to do and this is how I'm going to do it, and ignore the noise and just keep the main thing the main thing. If I were a developer right now, I'd be licking my chops because nothing's being built right now. Everything's old, everything's tired, and it doesn't matter what brand it is. If you go build a good box in a market that's nice and new, people are going to go stay there. And there's capital out there to go do that, and more capital today to go do that than 90 days ago and then 90 days before that. But you have to have the conviction in the market and the business plan, and you have to go to somebody, whether they're up on the stage or somebody out there, and look them in the eye and say, I'm going to be able to get this project built and it's going to make money. And if you could do that, then now's the time to go do it, regardless of what's happening today or what's happening tomorrow, because you're delivering in 24 months. I don't know what's going to happen 24 days from now, let alone 24 months.
That didn't give me a lot of confidence with 24 days. Yes,
We have a question
We
up
have
front.
a mic runner up here in the front.
Here she comes.
Thanks. So on a panel very similar to this last year, there was talk about, I think it was Basel III requirements, maybe changing banks' ability to lend into riskier loans. Could you review what happened with that, and if there's anything on the horizon in the next 6 to 12 months that might change the setup for bank lending? And the second thing is also on this panel a year ago, there was a lot of talk on, if you want a loan, you got to park deposits with the bank, maybe 10 to 20% of the loan amount. What doesn't seem as much of a conversation this year. How has that evolved in the last 12 months?
I'll take the deposit one. I mean, we've consistently seen that lenders are requiring fewer deposits. We did a construction loan that had 9 bids on it, and the differentiator was not doing deposits. So we're consistently seeing that is a much, much lower requirement. That being said, to Nod's point, the relationship matters. So, is there an opportunity for deals to move forward without a deposit? Absolutely. Are there scenarios where it makes sense because it offsets something else? I would say most definitely.
Yeah, it's overall return, right? So if I'm charging you SOFR 400 and I can make the return work, I don't need your 10 million of deposits. But if I'm charging you SOFR 300 and I need that 10 million deposits to help my overall return for that relationship or that loan, then yes, I need that 10 million deposit. So it comes down to overall relationship, right?
I think it's more with us. We like to do business with people that do business with us. So we would very much appreciate a depository relationship. We have several large relationships where we don't enjoy as big of a relationship on the deposit side because they just don't have the structure set up to do that. So we take them individually, but again, we like a whole relationship, treasury management, deposit, and we like to lend. So it's important, and it's a discussion on every deal. But we also look at the quality of the deal and go from there. As you were talking about Basel, I don't know that any one of us is an expert. Anad and I are the two on that because we're in the regulated banks. I don't know that if it's riskier today or what the changes are going on there. I'm sure there's going to be some deregulation given the current administration. We're back to we just do the right deals with the right people, and if we need to structure through, we do it in a collaborative way. So I don't know that anybody here is hesitant to lend today that we would have lent to last year. In fact, I think we'd like to double down on a lot of the relationships.
Yeah, so the Basel III, you had to reserve extra capital for different types of loans, like whether it's construction loan or higher levered loan. And so when you put all that in and you reserve that extra capital, it goes back to the return, right? I have extra capital for that loan now, for that construction loan or that higher levered loan, what's my return? And so you have to have a higher return for that same loan through that Basel III requirements for lenders.
It just doesn't seem to be a discussion today as it was a year ago.
Correct, yes.
Hopefully that answers your question.
We have another one right here.
I'll apologize in advance for the elementary nature of my question, but expenses are increasing, our margins are compressing, yet I consistently see DSCR and debt yield requirements going up from all lending. Do you see anything on the horizon where you guys accommodate for that as well?
It just depends on who you're going to, right? I mean, banks, they have no upside in making a loan, only downside, so they need debt yield and they need debt service coverage. We've done a bunch of deals over the last 18 months that were, sub 10 debt yields, and maybe it was stabilizing to a 10 or even less, but you're in a market where we feel comfortable underwriting the basis and underwriting the cap rate that those deals could effectively trade at stabilization. And so we get comfortable there, but that's the difference between going to a private lender and going to a bank is, those requirements.
But Jared, are you underwriting to an exit that's a sale transaction then, as opposed to a refinance? Because in a lot of bridge scenarios, you're underwriting to the refinance and where the expectation of the market will be in 3 years. And in that case, you're saying, to your question, Neil, if the market's at a 12% debt yield and you're underwriting a 10.4, you have an expectation that that's a sale transaction as opposed to a refinance.
Potentially. I mean, it used to be taboo to go, bridge to bridge. Now most deals are bridge to bridge. So yes, if you're underwriting to a tight debt yield, you're expecting a sale exit, but there's another group like us that could come around and take us out too.
Gotcha.
I would say that same thing, and I would say in terms of getting more aggressive, I'd say a lot of the assets we talk about there's still the story to be executed during our duration. So usually they're needing to execute a story to get to that coverage ratio or whatever that debt yield is. And on certain assets, I can tell you we've certainly gotten more aggressive on extension options and things like that. So what might have been something underwrite to a 12 could be underwrite to 11, things like that, being a little more aggressive around if you want to get to your extension hurdles and tests and things like that. Where I think, but it's really hard though. To the other point, if you hear the story is just called declining NOI margin, declining NOI, that's just a period of hard loan to make at the end of the year, unless you've got a real, so if it's just a stabilized asset where it's going the wrong direction, and a lot of times you just don't know what to do with that, right? Unless there's a very real bottoming in that story.
So I think we are at time and slightly over a little bit. We really appreciate everyone's time today. I think, again, everyone here is active on the hotel finance side in various iterations. So feel free to, thanks for your attendance, and feel free to ask those questions after. Thank you.
Thank you, Neil.
Interesting.